Please send me that recorded.
All right. Let's get started now. This is the continuation of the last class. This software effects of Forex Basic 1 continuation. So this is where we stopped the last class. This is where we stopped.
Yes.
Okay.
Yes.
So okay. So have you downloaded MT4? Have you downloaded MT4, right?
No, I told you.
Okay, yeah, I told you that if you already have your MT5, there is no need.
I still need to download MT4.
No. Since you have your MT5, there is no need. Since you have your MT5, no need. So let me just, the how currencies have been abbreviated on the Forex market. And if you check a MetaTrader, you would have seen EUR, that's Euro, USD, that's for US dollars, CHF, that's Swiss franc, and all. It's all on your MetaTrader. If you go through it, you're going to see everything there. It's all on your MetaTrader. By the time we get to practical, you see all that. You see all that. And when you have a combination of or a combination of two currency, which is making a pair, let's say AUD CAD, or let's say CAD JPY, there is one we refer to as the base currency. The first one, the one that comes first, is referred to as the base currency. Base currency, yes. Why the one that comes first is called the base currency, while the second one is called the quote currency. Yes, for instance, in the case of AUD CAD, we have AUD as the base currency, while CAD is the quote currency. So you get. So all this, you just have to bear all this in mind. It's going to help you in your journey as a Forex trader. Have to bear all this in mind. So currency pairs are grouped in two, as in two categories. Currency pairs are grouped in two categories, not even in two, but two major categories. We still have another one, but I'll be mentioning it. We have the major pairs and we have the cross or minor pairs. The major pairs and the cross or minor pairs. And when we are talking about the major pairs, we are referring to any pair that has a cross with US dollars. Any pair that is crossed with the US dollars, they are the major pairs. Look at what I have on my slide there. I have Euro USD. I have USD JPY, GBP USD, USD CAD. Anything that is crossed with the US dollars is referred to as the major pairs. They are the major pairs in the market. They are the major pairs in the market. So we have the next one, which is cross or minor pairs. These are cross or minor pairs. They are pairs that doesn't come with USD. There are other major or other important pairs in the market. Like you see, we have Euro JPY, GBP JPY, CHF JPY. USD is not none of it is carrying USD, whether the base currency or the quote currency, none is carrying USD. They are referred to as the minor pairs. Minor pairs. Then the third one, which I'll be mentioning, is exotic pairs. Exotic pairs. They are formed when any major currency is paired with an emerging economy. As in a major currency is paired with maybe an emerging currency, like we have or the ones in the category of emerging currencies, South African Rand, that's ZAR. Maybe probably you would have seen Euro ZAR. euros are in the market, they are exotic pairs. USDs are. All these are all under the category of exotic pairs. It's just for you to know all this so that you have a total knowledge of what is happening in the market. So just bear all this in mind.
Okay, sir.
So I'll be discussing these
Okay, sir.
concepts just for you to. Yesterday I was talking about you looking for other terms, other terminologies that are being used in Forex. Hope you did a personal research about that.
Other terminologies.
Yes. Yes. Please do a personal research on that. That's why I gave you a site where you can get loads of information, babypips.com. You can get loads of information about Forex there. So whenever you are less busy, just visit babypips.com, read everything you want to read. You see all babypips.com. Although I'll be sending you some PDFs as well. I'll be making some PDFs available to you, but still do your personal research too. Let me just quickly talk about this concept: volume, liquidity, and volatility. Volume is the amount of trading going on, at a particular period in time. Amount of trading going on at a particular period in time in the market. Amount of trading going on. So when we say we have high volume in the market, that means that is when the market participants are doing large number of trades in a certain currency pairs or certain assets. That's when we have high volume. And these are the times that is advisable we trade, because when there is high volume in the market, when there is high number of participants in the market tends to move very fast. And that is where, when the market is moving is when we tend to make our money. And that's why you see people trading London session. That's why you see people trading American session, because those periods we have huge participation in the market. Now you see people coming into the market at that very point in time, and people come in and trade so that in order to make take the best advantage of the market. So when we say we have low volume in the market, low volume is when there are not many trades going on, e.g., bank holidays in the US and the UK. Like we had bank holiday in the UK some days ago. The market will be slow. Like when we are getting to December period, that all these big companies that are also participants in the market, in the forex market, tend to go on holiday. The market will be slow. You just see the market consolidating and all. So that is when we say we have low volume in the market, when the market makers are not really participating, they are out. We have low volume. So another concept here is the concept of liquidity. This is the number of market participants in the market. Liquidity can also be looked at in another aspect, which we are really going to be we are really going to be delving into. The concept of liquidity is a whole topic on its own. Like I said, I'm still laying a background. I'm laying a background knowledge of Forex. That is what I'm still doing at the moment. By the time we get into practical, as in into what we really want to do properly, liquidity is a whole topic on its own. Because like I told you, I'm going to be teaching you how to, trade using using technicalities, and at the same time, how to make use of smart money concept. That is the market makers' way of approaching this market. So when we get into smart money concepts, liquidity is a whole topic on its own. And liquidity simply means money. To the market maker, it simply means money, because these are areas where they can easily, make a whole lot in the market. And that's how these banks and all, that's how they look at the market. So we are coming back to liquidity properly when we get to smart money concept. So let's just keep the aspect of liquidity, because we are still going to delve into it for real when we get to smart money concepts. So let's look at volatility. This is when the market behavior starts changing rapidly or sluggishly. So we can have high volatility in the market. At the same time, we can have low volatility in the market space. When we say when the market is said to have high volatility, that is when there is, high movement in the market. You even see how the market will be moving rapidly, and when we have low volatility, the market will just be sluggish, and it won't even interest anybody to come into the market. So it is advisable we enter the market when we have high volatility in the market, because that is when you can easily make very good money out of this market. That is when you can easily make very good money. So now we are going into the next lecture, which is going to be lecture 2. So let's quickly look at some of the important concepts here then before we get to the practical aspect. So what is a pip? A pip, probably you would have heard, oh, I made 50 pips, I made 100 pips, I made such number of pips. Just like human beings, when you are going anywhere, you take steps, and you can count the number of steps you have taken from one location. Probably you are assuming you are staying on the highland, you are coming to the mainland. You can count probably if you are just taking a stroll from one location to another, you can say, okay, I've taken 100 steps from Bagada to Oshodi, or from one location to another. The same thing with pips. The market movement in the Forex market is calculated in pips. That means movement from one location to another. If you are buying, you are expecting the market to, to go from low to high, from down to up. That movement is calculated in pips. That's why you say, okay, I've made 20 pips, 50 pips. The movement in the market is calculated in pips. And what is the meaning of pips? It is price index point. That is the meaning of pip, price index point. And it is the basic bedrock of your analysis and profit calculation. Pips are used in calculating profit and loss in the market. This is a very important factor that will be considered at the end of the day to calculate what you've made in the market in terms of profit and loss. So this is very important in the market. And there is a way we calculate pips in the market. There's a way we calculate pips. By the time we get to look at our trading view and MetaTrader, I'll just show you, a tool we use in calculating pips in the market. I'll show you a tool we use in calculating pips, both on the synthetic market and on the currency market. So let's just quickly delve through the what's it called? The other theory aspects, so that we can get past all this theory. And okay, let me talk about the concept of lot sizing. Lot sizing in Forex is the amount or quantity of a particular currency pair that you trade at any point in time. When you're talking about lot size, just lot sizing, I like using the concept of land to explain lot size. Okay, assuming you are into farming, and you have a plot of land, and I am into farming as well. I have 2 acres of land, and we both plant maize on our plot of land. At the end of the day, when you are harvesting from one plot of your one plot of land, and I'm harvesting from my 2 acres, definitely it is possible we even planted the same day and we harvested the same day. But when I'm bringing out my harvest, because I I planted on 2 acres of land and you planted on one plot of land, the volume that I will have in terms of harvest will definitely be more than your home, but we planted on the same day and we harvested on the same data as well. So that's where the issue of lot size comes into this market. Like, lot size is the amount of a particular pair you are buying or selling at a particular point in time. And it goes a long way together with the number of pips you've made in the market to calculate your profit or loss. So it is possible for you to enter the same market with somebody and the profit at the end of the day might be different. You can take the same trade on Euro USD and somebody is making $50 and you are making $5,000 on the same trade, on the same number of pips, but lot size will differentiate what each person will make at the end of the day. So using lot size in the market, you have to consider your capital per time, because you won't, because somebody is using a standard lot size, you want to use a standard lot size without considering your own capital. Because lot size, we make use of lot size based on our capital. That's where we have a standard lot size, we have a mini lot size, and we have a micro lot size. And for you to use a standard lot size, which is the highest in the market, you are expected to have 100,000 and above in your trading account. 100,000 and above in your trading account. Well, for you to use a lot size, the least lot size, which is 0.01 on the currency market, you should be looking at maybe if you're having $50 to $100 in your account, then you are expected to use the least lot size. You are expected to use the least lot size. So by the time we get to practical, you get to see all that. You get to see all that. This is just, like I said, I'm just laying a foundation of what you are expecting in the days ahead. Just laying a foundation of what we are expecting. Okay, like I said, the lot sizes, we have a standard lot size. We have a standard lot size, mini lot size, and a micro lot size. And a micro lot size. So when you click on 1.0, when you're setting your lot size on your MetaTrader, that means you intend using a standard lot size and so on. So all these are very important when it comes to your profit calculation and your size, your position sizing in the market. All these are very, very important. They are very important. So let's now talk about risk management. This is very important. I like to talk about risk management a lot in Forex because, I've seen so many great traders, and at the end of the day, they don't have $1 in their account. Yet when you see their analysis comes out very wonderful. You see them drawing trend lines, support and resistance, what have you, order blocks and all. But at the end of the day, they keep on blowing account. And why is it so? Why is it so? Risk management. Risk management. You can have the best strategy in the world and still end up blowing an account. If you don't know how to manage your risk in Forex, if you don't know how to manage your risk, you end up blowing an account. It is not a strategy that makes people make money in this market. Your risk management is very key. You can lose 6 trades in a row. I'm telling you, you can lose 6 trades in a row, and on the 7th trade, you are able to make profits and it will cover all your losses. That's if you are working on the right risk management. So it's not, if you are risking what you are supposed to risk per time, then it will be hard for you to blow an account. Like I do tell my students, on every of your trades, do not risk more than 3% of your total account, such that if you have $100 account and on each trade you are risking just $3. That's 3%, just $3. When you lose the first trade, that means you have 97 left. You lose the second trade, you have 94 left. If you lose the third trade, that means you have $91 left. Just imagine how many 3% you would have lost, how many times you would have lost for you to ruin an $100 account. But you see, because we look at this Forex trade as a quick rich scheme. Money some people have not made in their 10 years, they want to make it in a single day in Forex, and that is where that is where problems set in. If you look at Forex as a long-term thing, then it will take away the mentality of let me quickly double my account today in the Forex market. Well, people do it. You see all kinds of video on YouTube. You see people coming out, I took $1,000 to $5,000 to $10,000. Fine, you can do that in the Forex market because the market is very liquid. Like I said, $5 to $7 trillion is traded in this market on a daily basis. You can make a whole lot. But if you're aiming at doubling your account, that means you are opening your account to so much risk. At the end of the day, you can make so much money. Then when your risk is more than necessary, you can blow the account as well. Most of the guys you see coming on YouTube, I flipped an account from 1,000 to 15,000 in a single day. When they blow that account, they won't return to YouTube to come and post it that, okay, I tried to flip 5,000, then I blew it to zero. That's the issue I have with most of them. You only see them on YouTube coming, I flipped $500 to $10,000. But when they blow that such an account, because they keep on trading that way, I've seen somebody, I have a friend that lost, a whole lot. I'm talking $84,000 within 1 hour because of the way he trades. But if you are risking 3 to 5% of your account on every trade, it will be hard for you to blow an account at the end of the day. It will be hard for you to blow an account, but most students, after talking to them like this, they still go ahead and do something else behind. For you to be successful in the Forex market, you must be ready to follow rules. Without rules, you are going nowhere. I trained with, the platform I trained with is one of the top Forex academies in the world. Yet I see people under the platform blowing accounts severally. And why is it so? Many people don't keep to rules. For you to be successful in the Forex market, you must be able to keep to the rules. It's a game of rules. If you are not keeping to the rules, the market will deal with you ruthlessly. So let's look at some of the concepts that are very important in the Forex market. The issue of drawdown. You must approach these markets with the mindset that markets won't always go your way like every now and then. There are times you enter the market, you are clicking buy, the market is going against you. We call that drawdown. You approach this market with the mindset that, okay, you define your loss and your profit before you enter any market. It is not when the trade hits stop loss that you'll be caught by surprise what you are losing. There's no trade I'm entering that I don't have an idea of what I can lose in the market. Don't let anybody force you into a market whereby you don't have an idea of what you can lose. When I was coming up as a Forex trader, I got to a point in time that even if my mentor is dropping a trade for me, what I ask from my mentor first, what is the stop loss? Because when you enter a trade without a stop loss, you are not defining your loss. That means you can lose the whole of that account. But if you have a stop loss is there in case the trade don't go your favor, so that it can cut short your loss. But many people make that mistake today. They want to take a trade without stop loss. when you are not the market makers. When you are not the market makers, when you are not one of the top banks in the world that has huge amount of money in their possession, they are the one that goes into trade like that without, they go into trade, you see them edging the market, buying and selling at the same time because they have the huge fund. But if you are still playing with an amount less than $100,000, you must be very careful the way you trade because this market is very liquid. Like I said, I've seen somebody lost $84,000 within 1 hour. So let alone if you have $100,000, if you are not so careful, you lose it within minutes in this market. So risk management is very key. And this is just an introduction to risk management. We, at least before the end of this course, we are still coming back to risk management at least twice because it is very important. I've seen, in fact, guys that has their own channel on Telegram and they blow account because of risk management. So I like to, place more emphasis on risk management a lot. So risk management is very key when it comes to trading. When it comes to trading, risk management is very key. Like I told you, you are expected not to risk more than 3 to 5% of your total account. Like what I tell my students is, okay, on currency trade, you are expected to just risk, let's say 3%. Then on volatility pairs, that's synthetic indices, just don't go beyond trades that are more than 5% risk on your account, because this risking just 5% of your account is a way of planning for loss, because in this market you won't win every now and then. Even if your mentor is the one dropping trades every now and then, you must approach it with the mentality that you won't win the market every day. There are times you have winning streaks that you take like 10 trades in a row, you win all the 10 trades. That doesn't guarantee that you take the next 10 trades, you win it. There are times you take 6 trades in a row, the market will just play anyhow and you lose it. So, but if you have the right risk management, like what I do is any trade I'm taking, I make sure the rate, if I'm risking 3, the 3 has the potential of giving me at least 3 times of whatever I'm risking, so that if I'm risking 1 can give me 3. I don't risk 1 for 1, so that even if I'm losing, whenever I'm losing 1, but whenever I'm gaining at least 3. And that's how to gain edge over this market at the end of the day. So that even if you are losing, at the end of the day, your risk management will give you edge. There is no holy grail in this market. No strategy is holy grail in this market, because even the market makers, the top banks in the world, they lose in this market. So who are you not to now lose in the market? There is no holy grail, but the only safe haven in this market is your risk management. You see, I'm placing more emphasis on risk management because it is very key. It is very key. If you can master risk management alone, you have gained a lot in this market. You have gained a lot in this market. And after this class, I'll be sending you at least 2 PDFs on risk management. Please make sure you read it. I'll recommend a video too that a video you are going to watch as well on risk management. I recommend it. You watch it, you sit down with it and watch it and jot whatever you have to jot on it. Risk management is very key. It is very key. So let's just look at common mistakes made by traders. Common mistakes made by traders, which I've seen so many people making this mistake over and over again. And one of these mistakes is trading without a plan or journaling. Most traders just go into the market. They don't have a plan of whatever trade they want to trade. They just don't, they are trading, go into the market, no proper plan before they go. They don't plan what they have in mind to lose in case the market is not, because most people are just looking at, I just want to go in there and make profit. They are not looking at, okay, what if loss occurs? How do you handle it? how do you go about it? They are just thinking about the money-making aspect. So this is where plan comes into place. Okay, on this trade, yes, I want to take this trade. On this trade, I'm not ready to lose more than $50 in this trade. When the loss is going to $50, please cut me off. I'm not ready to lose, because when you are losing in a particular trade and the loss is getting more than what you can accommodate, it's going to affect you psychologically. You won't think straight. Just imagine probably you have your school fees. You quickly want to double it. By the time you place it in the market and you are losing half of it, you won't think straight any longer. You won't think straight. So there must be proper plan for your stop loss and for your take profit in this market. There must be proper plan. If possible, every trade you are taking, have a plan where you just, okay, I'm taking GBP USD, this is my stop loss, this is my TP, and how. Proper journaling, proper plan. Like I'm going to give you a trading plan you can work with. And you can use to build up your capital. Like gradually you use it to build up your capital. That's if you keep to it. If you keep to it. So trading without a trading plan is one of the common mistakes. Trading without a stop loss, I've said this before, you must make use of your stop loss, irrespective of what you are trading. You must make use of your stop loss. The only situation whereby I know making use of stop loss might not really work is when you are trading against the spike on synthetic indices, crash and boom. That's the only situation whereby stop loss might not work, when you are trading against the spike. And for you to trade spike and boom, you must be knowledgeable in Forex to an extent to trade crash and boom. Even if you are not setting your stop loss, you must still have a limit that, okay, if the spike is not coming, if the trade is not going your way at this particular point, then you accept your loss and move on to the next trade. Then there is another thing that is called revenge trading. What is revenge trading? Assuming you have a setup for buy, you click on the buy, market goes against you and is now selling. Because it's now the market has taken out your stop loss and is now selling, you are not even considering every other thing. What you do next is, I want to recover my money. You click on sell again. The setup you have is for buy. You've not even checked maybe the market, maybe the trend has, really changed to a sell market. You click on buy, you click on sell because you quickly want to recoup your money. That's revenge trading. That's not, when you want to be a professional in this market, there are some things you don't do. You only work according to your plan. When you have your setup before you take any trade, you have your what's it called? You have your proper markup. You know the market structure. You know the trend of the market. You know what the market is doing. Not that you just go in because you see a red candle, you click sell. You see a green candle, you click buy. No, things are not done that way. Things are not just done that way. Then another thing is letting losses, or let me say losing trades, you let it keep on running with the mindset that it's going to come in your favor. I was in a particular place some time ago and people were discussing that a particular man sold gold and he left it, and gold, that was the time there was a particular crisis then, that was making gold to rise up. Particular fundamental that was making gold to buy like mad, and he was selling, and he held the sell with the mind that gold will soon sell. And he had in his trading account, he has had loss up to $54,000 as at the time the people were sharing his story. And he was asking what should he do? Should he leave it to be running or should he close it? Assuming you have your proper setup, you have your what's it called? You have your limit, which is your stop loss. Now, okay, if the trade is not going my way at this point, cut it off. You won't have to incur a deficit of $54,000. Just imagine how far $54,000 would have gone in the life of anybody. Even if you don't want it, dash it out to the people that need it. So the issue of stop loss cannot be overemphasized. It is very important. It is very important. You don't let losing trade. I say this, I tell my students that, see, when it comes to the Forex market, there's a limit to engaging the markets, the Forex market in prayer. There are some things you don't need to pray about. When you see a trade is not going your way, you know what to do. Take it out, move to the next trade, not praying and hoping the market should come back to your way. No. You must be ready to accept loss in this game. If you really know you want to take Forex as a trade, as a career, you must get to a point that, okay, if this market won't go my way, I've accepted my loss. Yes, I'll take the next trade. Because if you blow your own money on a particular trade, what will you have left to take the next trade? That's what many people don't consider. What will you have left to take the next trade? If you've blown all your money on a particular trade, that should really be considered a lot. We should really consider that a lot. So risk management is key. Then having unrealistic expectations is another common mistake. You see people, they come in with a capital of $100, and when you ask them, what is your daily target? They'll be telling you their daily target is $500, and you have a capital of $500. Come on. The Forex market is not a ritual market. It's not a money ritual market. It's not a money ritual market. How, if it is that easy making $500 daily with $100, you think nobody will go to school again? Everybody will face the Forex market and start taking their own share from the market. So you must have realistic expectations. When you have $100 account, then if your target per day, if you have made up to 5% in a day on a daily basis, up to 5%, you are good. You are good for the day. You are good for the day. But when you see people coming with just very little capital and aiming for a very high amount of money, that's where they land the total accounting problem. That's where they land the total accounting problem. Even when you meet professional guys out there, they will tell you when you make 10 to 30% in a month, you have tried. You have really done so well in the Forex market. That's for you to know how complex this market is. So realistic expectations is very key when it comes to the Forex market. Realistic expectation is very key when it comes to the Forex market. Don't let us go approach it, in such a way we are not supposed to